For decades, the world has speculated about the possibility of China surpassing the United States as the world's largest economy. Some reports said that China would overtake the US by 2028. Others said it would be by 2035, but more pessimistic reports say it will be 2060. The goal of 2028 was even a solid forecast, as outlined by many news articles out there. One article published by China Daily, which is an English-language newspaper owned by the Chinese Communist Party, quotes numerous articles as to how China would overtake the US by 2028. It wasn't really impossible for China to overtake the US back in those days. Here's a comparative graph of the two nations' annual gross domestic product, GDP growth data from the World Bank. You can see that from 1990 to 2020, China's GDP growth every single year has outpaced the United States by a huge margin. There were even 2 strong years where China showed substantial economic growth during the 2008 global financial crisis and the recent COVID-19 pandemic. You can see here in the graph that the US economy contracted by 2.6% in 2009. And even grew at a small rate of 0.1% in 2008. Yet, China's economy went full-on growth mode, with over 9.6% growth in 2008 and 9.4% in 2009. In 2020, the US had contracted by 2.2%, yet China grew at 2.2%. Every single year, China has outpaced and outshined the US. That is easy to see as to how China would overtake the US. And if we take a look at the GDP of both countries as reported by the World Bank, we see this. From 1990 to 2020, China's economy grew from just $360 billion to a massive $14.69 trillion. The US economy, on the other hand, was at just $21 trillion. This gap was very, very small, and chances of China's economy catching up was very likely by 2028. But this is where the story changes. If we adjust these years and add up the recent years from 2021 to 2023, we get to see a very different picture. You can now see from the graph that the entire story has changed. China's economy, which was growing fast and massively, had suddenly slowed, or even worse, stagnated. In 2021, China's GDP was $17.82 trillion, yet by 2023, it's just $17.79 trillion. Comparatively, the US economy had grown massively to over $27 trillion. This raises a very important question. Will China's dreams of surpassing the United States may actually never come true? Or even if it will come true, will it likely be further than the projections of 2028, 2035, or even 2060? Well, it is difficult to say just how much China has to climb to reach the United States from here on out. However, it is first and foremost important to actually understand why China's economy may never reach the United States. Yes, that's a bold statement. China's economy, which is the world's largest manufacturing hub, and an economic structure that has everything it needs to catch the US, may not actually catch it at all. How can we say this? Well, it's largely because of 3 key problems that we see. The first is because of China's demographic shift, followed by a change in sentiment between the US and China in relation to trade and investments, and thirdly, because of domestic difficulties that have hampered economic growth in the short term. The most important of these are, of course, the US-China relations, so we'll start from there. Over the past few years, since the rise of Donald Trump as president, we saw a huge shift between the two nations' trade and investment. Here's a graph of the US-China international trade in goods from 2014 to 2023. As clearly seen, from 2014 to 2018, the trade in goods between China and the US has continuously gone up. Yet when Donald Trump initiated his tariffs in the early months of 2018, followed by retaliatory efforts by China, The trade between the two nations shrunk in 2019. Even after Trump ended his first tenure, the next administration of President Joe Biden had launched his own tariffs on Chinese goods, which continued the difficulties in international trade between the two nations. But why does this matter for China's economy? Well, that's because the United States is one of China's largest trading partners. A significant portion of China's export-driven growth relies on selling goods to the US. When tariffs increase costs, demand for Chinese goods often falls, directly impacting Chinese manufacturers and exporters. One of the greatest examples we can see in this story are the Chinese companies known as Huawei and ZTE. Huawei and ZTE were famous Chinese companies that rose to prominence in the telecommunications sector. Yet, Donald Trump's administration clamped down on the Chinese companies, citing national security. This was then followed by several other Western-leaning countries to follow the same path. What were the impacts? Well, of course, lesser revenue streams and income for both companies. But, quantitatively, we can see this from their financial reports and even market share. Here's a graph of ZTE's net income from 2014 to 2024. As you can see, there's a distinct year where it lost a massive amount of over $1 billion in 2018. What led to this loss were the sanctions and trade wars between China and the US. Huawei, another player in the field, had seen a huge consumer sentiment change in its smartphones. Here's data from the global stats in mobile vendor market share worldwide. You can see how Huawei's smartphone market share had risen to nearly 11% in mid-2020. It was at this peak where Huawei as a company has been targeted with government sanctions and restrictions. They could not access critical components, softwares, and services that were essential in maintaining their lead. This has caused the company's market share in the global mobile market to drop. To top that issue off, there's also one more reason why Huawei phones have failed to catch up, and it's because of semiconductors. Semiconductors are now being referred to as the new oil due to their importance and widespread use in consumer technology such as smartphones and data centers to military and strategic significance. Without semiconductors, Huawei phones may not function at all. One of the ways the US is weakening Huawei is limiting chip exports to the company. Although Huawei still has access to semiconductors, they purchase them from a local Chinese semiconductor manufacturing company known as SMIC. However, SMIC does not have the capabilities to manufacture advanced chips such as 3 nanometers. These chips are the most advanced ones out there and are used in the latest smartphones like Apple's iPhone 15 Pro. Without these chips, Huawei's smartphone capabilities are outmatched compared to companies that have access to them. This is not only limited to Huawei, but also to many other Chinese companies out there, especially those that are linked to the usage of military equipment. But why? Why can't Huawei and other Chinese companies buy them? Well, that's where the chip war came in. The presidency of Joe Biden has restricted China from buying several chips from TSMC, which is the world's most advanced foundry service company, to NVIDIA chips and ASML equipment. This is going to pose a big problem for China's future. Without advanced chips, they will continue to lag behind the US and other countries that have access to them, potentially harming economic growth. Secondly, we must also talk about China's demographic problems. China has seen a slowdown in population growth and an increase in the aging population. Here's a graph to depict these. As you can see, from 1951 to 2018, the annual change in population has continuously gone up by millions. Yet, from 2019 to the latest year available of 2023, the population shift has gone down massively, with the latest year seeing a negative population change of 2.59 million. This issue is the same in the next graph that we'll see. Fertility rate, which is the number of children per woman. As you can already tell from the graph, it has gone down every single year. In 1950, live birth per woman was over 5.81, yet by 2023, it's just 1. This is going to be a big problem for China in the future, and it may stall the overall economic growth. Comparatively, the US has been consistent in its population change, not just because of its fertility rate, but also because it allows immigration into its borders. Hence, as you can already see from the graph, its population hasn't gone to the negative territory, and may continue to stay this way as the US allows more people to come into its country. Finally, the last issue that China faces is its economic structure. One of the biggest problems plaguing China is its investment-driven economy. What this essentially means is that a substantial portion of China's economic growth has been fueled by investments in infrastructure, real estate, and manufacturing, rather than consumption. Household consumption to GDP accounts only for 38% of China's economy, as of a report published in 2021 by the Penn World Table in the year 2019. This is unlike the US, which has a high household consumption to GDP ratio of over 70%. What this means is that China's economy relies heavily on investments and exports rather than domestic consumption to drive growth. This imbalance creates vulnerabilities that are increasingly difficult to manage as the global economic landscape shifts. An economy overly dependent on investments often faces diminishing returns over time. To top off that investment-driven economy, China also has problems with high household savings rates, which has been another impediment to increased consumption. Here's a graph with data published by the World Bank on gross domestic savings as a percentage of GDP. As you can see, China's gross domestic savings is so much higher than that of the United States. This, again, showcases how people in China prefer to save than to consume. Although some people might say that it should be better for an economy, it actually is a double-edged sword. For one, you get this investment-driven economy as high domestic savings are channeled into investments, but the other is that there is reduced consumption, which is crucial and necessary for an economy like China. But anyway, do let us know what you think. Thanks for watching.